Hello, my name is Jim Wade. I'm a tax attorney here in Portland, Maine, for those of you who don't know me. And what I wanted to do was start a series of videos on the new Tax Act. And I thought the best place to start is on alimony deduction, how it's changing in 2019. The reason being is I know a lot of family law practitioners, and there's been some sort of uh, people have been very upset by this. So I thought, well, let's talk about how it changes things and see if there's some workarounds. So let's get started. So prior to January 1st of 2019, alimony, if it meets the requirements of the statute, can be tax deductible by the payer spouse unless they agree otherwise. And this has been the rule since 1954. So we're talking 64 years. This new tax law change reverses that and falls back on prior treatment of alimony, which was alimony was not deductible by the payer spouse. And that was decided in Gould v. Gould back in 1917. I'm not sure why they made the change. I think it has two reasons. The first is it's an obvious revenue raiser. The spouse who got the deduction often was a higher earner than the recipient. So they would get a bigger tax deduction, as far as their taxes would be reduced in a far larger amount than the taxes paid by the recipient spouse who received it. So tax rate arbitrage. And I figure this is the way to get rid of it and raise more revenues. I also think the IRS was tired of dealing with tax court cases involving alimony. They were, I think, in any given year, you could probably find, I don't know, 30, 40 cases involving alimony. And always would be same or similar issues. I think they just said, you know what, people aren't getting it, they keep doing it, let's get rid of it. Those are my thoughts on why they did it. The conference report didn't really shed any light why they changed it, but we got to deal with what we do, and right now, alimony as of 2019 is no longer deductible. So, how is it treated before 2019? Alimony, if it meets the requirements of sections 71 and 215, was deductible unless there was an agreement otherwise. Now, once we hit January 1st of 2019 and going forward, any divorce decrees or separation instruments that are executed on or after that date, the alimony is no longer deductible, period. No way around it. Modifications of pre-2019 divorce decrees or separation instruments, those are okay unless, again, there's an express agreement that the new rules apply. So what can you do about it? Well, I think the most obvious thing you can do is accelerate the divorce so that it's completed in 2018. I mean, makes sense. What happens if I can't? All right, so you have some other options. They're not anywhere near as good as deductible alimony, but you still have some things you can do. Property transfers between divorcing spouses is a tax-free property transfer. That is, any transfer made within a year of divorce between the two parties, always tax-free. Thereafter, up to 6 years past the divorce, as long as the transfer is incident to the divorce decree or separation instrument, then it'll be tax-free. So if you have highly appreciated property, stocks, bonds, real estate, or middle interests, where the fair market value exceeds by a large amount whatever the taxpayer's basis is. Quick example, I have a piece of real estate, I'm holding it for investment, it's now worth $100,000, but I only paid $10,000 years ago. I have a built-in gain in there of $90,000. It'd be a capital gain. For me, let's say I'm making enough money where I'm in the 20% bracket. I'm sorry, 20% capital gain bracket. And by shifting it over to my ex-spouse, who's making a lot less, they can either pay 0% or 15% on the gain. That's a tax savings. So by transferring it over, I get it out of, I don't have to pay tax on it, and they can pay less tax. There's sort of a benefit there. Maybe I can use it in negotiations. You also have tax-deferred retirement assets that could be transferred. It's not, I guess we're kind of we're going from not quite ideal as alimony, and we're slowly going for less and less ideal solutions. The second one is transferring retirement assets, 401ks, pensions, IRAs, SEPs, and SIMPLES. By transferring it, you lose the benefit of tax-deferred growth in the account. But the recipient spouse, when they receive the benefits of these retirement, whether it be the payments under a pension or they have the IRA account and they start drawing on it, it's going to be taxable wholly to them. So there is that way to sort of shift taxation. Finally, this one, I guess I call it bleeding edge. If you're brave enough and your client has a business, you could have the ex-spouse receive a business interest, non-voting, of course, so they have no control over management, where they can receive a profits interest in the business, and they'll shift some of that profit from you to them. Or you could pay them as an employee. The wage expense is a deduction to the business, taxable income to the recipient. I assume the IRS is going to be sort of watching for schemes like this, but depending on the circumstances, maybe this will hold up in court. It might be a way to shift income. I would be remiss if I didn't tell you again about alimony pre-2019 and what it must, it has to meet the requirements of statute. And I've laid them all out here as to what's required. Too many people, when they draft the divorce decrees or separation instruments, don't look at this, and inevitably the IRS will audit their client, deny the alimony deduction, and obviously much hate and discontent ensues. So if you have a divorce that's going to be done here in 2018, make sure it meets the requirements of Section 71 and 215. I believe you can find those online at Cornell Education. Anyways, must be a written divorce or separation instrument. Oral agreements are not enough. Paid in cash or cash equivalents. I don't think I've ever seen anyone pay in cash equivalents, so I should probably just strike that and just say pay in cash. If you give someone property and say that's alimony, not going to work. There was a case where a woman was trying to sell a home awarded to her in the marriage, couldn't sell it, and so her ex-husband agreed to take the property in lieu of her alimony payments. Guess what? Not alimony. It was property, not cash. It must be made to a former spouse or on their behalf, and the former spouse must live away from the payor. They can't live together. When I say on behalf of, what they really are talking about is if your former spouse says, hey, pay my mortgage, pay my credit card, pay my car, that's fine. But it has to be paid on their behalf. No-brainer. If the agreement says it's treated as, alimony is treated as tax-free to the recipient, not going to be deductible. And finally, this is the one that gets everybody in trouble. The obligation to make the alimony payment must cease upon the death of the recipient spouse. If there's any obligation to make those payments, it's going to sort of poison the well when it comes to those alimony payments. And not just the one payment. If you have a stream of payments and the obligation exists beyond the death of the recipient, the whole stream of payments is not tax-deductible alimony. And I'll mention two quick situations where this comes up quite frequently. Lump sum alimony is the first. Seems like they're all coming out of Florida. But if you have an obligation to pay a lump sum to your spouse, and that obligation to make the payment extends to the estate, even if it's going to be paid within a very, very short time after the divorce decree or the separation instrument's executed, it's not going to be deductible alimony. And the last situation it has only come up recently, and I think it would surprise many people. Let's say you have a deadbeat spouse, hasn't been making their alimony payments, and finally the recipient spouse takes them to court, gets a judgment against them to pay a sum certain of alimony. If that judgment is payable to the estate of the recipient spouse, any payments made against that judgment by the payor is not going to be deductible alimony. You can look that case up. It's called Iglicki, Iglicki. You just type in tax court Iglicki and you'll find it. That's all I want to say about what you must do to meet the requirements of alimony. Final thoughts. Labels don't matter. State court law does not matter, except to the extent that the agreement is silent as to the obligation to make payments after death. Federal law applies. The intent of the parties does not. So make sure if you're drafting up a divorce decree or separation instrument that you follow the rules of 71 and 215. Otherwise, you're going to have problems. Now, with this alimony deduction going away, you're going to have to be more creative in negotiating resolutions of your divorces. You have to be more creative. And I kind of gave you a couple of hints as to where I would look. I'm going to continue to sort of think of ways that you can get around the alimony deduction in the sense of finding other ways to shift tax burdens to the recipient spouse. But I think there's not much more you can do. But lawyers are creative, and I'm sure we'll find a way. Finally, don't forget modifications that are made post-2018 and are for pre-2019 divorces. That is not covered under the new law unless the parties expressly agree otherwise. So don't forget that. I hope you found this helpful. If you have any questions about alimony or about any tax issue, I would love to talk to you. You can see here I've got my phone number and my email. Send it in. Also, if you have any ideas for future presentations, I would love to hear it. I'm always interested in sort of talking about tax issues for what people actually want to hear. I know what I think is important, but with you out there in the trenches, I'm sure there's tax issues that come up and that you wish someone had some answers for you. So you all have a wonderful day, and I hope you enjoyed my presentation. Thank you.